Okay, folks, welcome to the week ahead commentary. My apologies for getting this out on a Sunday, but I had some oral surgery done yesterday and was not feeling up to snuff. And I may not be doing a Sunday night Futures Live tonight. It's 50-50 whether or not I'm going to do it. But I will let you know in advance, of course, by sending out a 15-minute notification prior to going live if we do go live. So let's begin with a review of economic data last week, because the markets are behaving, of course, that there is global growth, the economy is doing well, and it's not. The only area where you saw a bit of hope last week was in the ISM non-manufacturing index. That's the services index, which beat. But the 1 month's worth of data shouldn't overshadow the fact that we have a manufacturing recession. That's in the books now. It's a fact. Factory orders last week declined worse than expected. So manufacturing here in the States is not good. It's a big, big problem. And when you take a look at the productivity numbers, which were reported last week, horrible, absolutely horrible. They expected a positive number of 0.6%. The actual was 0.3 to the negative. And add to that, unit labor costs rose more than what was expected, by more than a full percentage point. Now, that doesn't mean that because unit labor costs rose, that means that workers have more money in their pocket. No, it just means that the cost of having an employee increased, whether it be because of their benefits, whether it be increases in health insurance premiums, what have you. Those costs are rising. Another bright area was consumer sentiment, which was reported better than expected on Friday. Now, this coming week, obviously, we're going to have Veterans Day on Monday. No economic data to speak of. Before I forget, happy Veterans Day to everyone out there that is a veteran or has a family member that was a veteran. On Tuesday, we had the NFIB Small Business Index. That's important. That's a survey of small business owners. A lot of Fed heads out this week, including Powell on Wednesday. And also on Wednesday is the CPI number, the Consumer Price Index. Later in the week, we're going to have the PPI, which is the Producer Price Index. So Wednesday and Thursday of this week, Jay Powell is going to be out there. You're going to have Bullard speaking. Wow, Thursday is going to be jam-packed with Fed heads. And on Friday, you get retail sales. I was just in Best Buy only about a half hour or so ago. A lot of people browsing, a lot of sales. They have early Black Friday sales going on right now. Nobody's walking out with anything. And I was one of them. I went in there to take advantage of a sale, and I just didn't get the price I wanted on a new TV set. So I'll try it again tomorrow for Veterans Day. All right, let's move on to the charts. I want to talk about this is a quarterly chart of the 30-year bond price. I usually show this 100-year view, but I'm going to keep it streamlined for this conversation because it's to illustrate a point. And the point of the matter is this, is that thus far this quarter, we are very close to being halfway through the final quarter of the year. And we have an inside quarter, an inside candlestick, meaning we have not made a new high, nor have we made a new low versus the prior quarter. This is a bearish reversal bar. Very negative. And what I'm concerned about here is the fact that, the Federal Reserve very, very engaged with buying up short-term bonds, but they're not doing the same for the longer maturities. And what you're seeing is interest rates spike on the 30-year, the 10-year. Now, what concerns me here is that if we put in a double top and then begin to break down and close down below the lows last seen back during the October quarter of 2018, that would be a confirmation breakdown, and that means there's going to be blood in the streets. I don't know if the Federal Reserve is going to allow that to happen. I think that at some point in time, in the very near future, they're going to need to begin to start buying back longer dated bonds. And if you're wondering when gold and silver will catch a bid in the miners, that's when that's going to happen. And I think we're going to get an announcement at some point in time fairly soon. And I'll share with you why. Take a look at this chart here of the iShares U.S. Construction ETF. We came within pennies of taking out the highs of, I believe, 2018. Yes, 2018. We've had a nice rally in 2019. But you can see here we had this spike in yields. And all of a sudden, the rally died out in the U.S. home construction ETF. So perhaps we'll bull flag out here. But if we begin to see job losses in the construction area, I think that that's going to be the signal, or one of the signals to the Federal Reserve, that they need to begin buying up the 10-year, 30-year bonds to suppress those rates. Because if you see, here's a 10-year yield. If you begin to see a two-handle on the 10-year yield, that doesn't mean it can't move higher with a two-handle on the yield, meaning the stock market. But it feels a lot better when you have a one-handle and you're long of stocks than when you have a two-handle, because we know what happens once you start getting up into the high twos. When we were at $20 trillion in debt at 3% on the 10-year yield, the stock market, which is overlaid here in blue, rolled over. Now we have $23 trillion in debt. At what point in time does the market scream uncle, saying that, you know what, we can't afford these debt payments, and I mean debt payments on the federal debt? What is the magic number now? 2.7, 2.9 on the 10-year yield? I don't know. But the higher that the national debt goes, the lower the ceiling becomes by which the markets will accept a rise in yields, because you're going to hear a giant sucking sound of money leaving whatever comes into the Treasury and going out as debt service payments to whoever owns our treasuries, namely the Chinese and the Japanese. So while this is very, very impressive, last week's bond yield rally, I really question how sustainable it is. And at what point does the Federal Reserve not allow this rally to continue? Taking a look at the VIX weekly chart, bearish key reversal bar, which implies that we are going to go higher on the stock market, the U.S. dollar. An amazing week last week. So much for declining Stokes, or bearish for the dollar anyway. It certainly bucked that very, very reliable rule of thumb I have with regard to declining Stokes below 50. It bucked that trend. The dollar rallied last week, an outside reversal bar. Very, very powerful. Perhaps we'll pull back to a retest of 97.5. Would I be surprised if we just broke out higher? No. Looking at the dollar bull ETF 4-hour basis, we may just be setting up for a pullback here. This is a beautiful W formation. I mean, up volume on a daily basis last week was not wonderful for the dollar bull ETF, which would imply to me that we have some short covering. We saw shorts covering in the back half of the week. And Friday, we had a hollow-filled candlestick. We're probably going to pull back here on the dollar early in the week. Later in the week, I wouldn't want to make a prediction at this point in time. The weekly chart is very bullish, so in all probability, we'll get a quick pullback and then probably a move higher. The Dow Jones, let's go to the transports first. Yeah, a huge move last week on the Dow transports. We saw a sell-off late in the week on the Dow transports. Perhaps we'll get a short-term pullback, but net, I mean, this is a very, very bullish breakout. I mean, we broke out here the week of the 21st, did a retest last week, followed through, continuation breakout last week. Volume was a bit light. Back to the Dow Jones Industrial Average. Continuation breakout last week. The indicators look spot on. RSI broke out, confirming the breakout on the Dow. Volume, though, I mean, this is going to be a trend here. Volume is light. The S&P 500 weekly chart, a continuation move higher last week. on volume no less. All the indicators look good. In all probability, we are going higher this coming week. The semis shot up higher last week, a continuation move. A little bit extended here. Volume is not good. Horrible volume. Stokes are very overbought. Expect a pullback here on the semis. Healthcare, a beautiful breakout last week. We want to be buyers of Cure. We'll go to that chart in a moment. Volume outstanding. Love this chart. We finally have our breakout. We have a retest. All systems are go for healthcare, folks. The banks weekly chart, a continuation move higher. Volume not good. Not good. Let's go to a daily chart on the banks. They have been leaders. All right, so Friday we had a pullback, a pause that refreshed. We filled the gap. It looks as though we're probably going to press higher here on the banks, especially if we see a continuation move higher on a weekly basis on the 10-year yield. I would ignore this volume. It was high volume, but we rallied way off the lows of the session on Friday. And we were, for all intents and purposes, flat on the session. Oil, weekly chart, RSI, continuation breakout. We broke out on price, folks. Volume was good, about average. Taking a look at the energy sector. Let's update this. Did we break out on energy? No breakout on energy. We tried it. We were denied, or they were denied, I should say. We may get a breakout. If we see a continuation move higher on oil this coming week, we'll probably see a breakout on energy. The indicators look very, very good. I just don't like the topping action here, but you can rationalize it. We hit resistance, and you had sellers move in, and you saw some technical selling. No big deal. This is another view of housing and the impact of yields. I mean, we were not very overbought here. And to see this type of selling, nearly a complete outside reversal bar, a very bearish setup here for housing. And I'll bet you a nickel, you could lay the blame at the doorstep of yields, which is ripped through the ceiling last week, and it's not good for the sector. They are going to come under increased pressure if yields continue to rally here. So I think this repo action that the Federal Reserve began back in September, buying back shorter-term bonds, meaning 3-month, 5-month, that's going to get old really quick. They're going to have to expand it out to begin buying 10-year, 30-year debt, and that'll put a bid back under housing and construction. Taking a look at gold. So gold broke support last week. I mean, what a difference a week makes. Because this time last week, I had a very bullish tone. This is the gold miners, wrong chart. I had a very bullish tone on gold because we had a bullish reversal bar. We had broken out on the gold miners. Fast forward through a week, an outside reversal bar. Very, very bearish price action here for gold. We did close at the 1460 level. We're down on big volume. So a new weekly low, and we're going to have to consider lightening up more on the NUGT position. Silver is not that big of a position, so we could go a few rounds there, but I'm more concerned about preserving profits on the NUGT. Because if the Federal Reserve continues to delay buying up longer dated debt, that is going to put a hurting on a lot of things. It's going to put a hurting on the consumer because their cost of borrowing is going to increase. Taking a look at the Stokes, weak and getting weaker. Just a bad setup here for gold. My tune will change if we do gap up on Monday and we do not take out last week's lows. If we take out last week's lows, it's not going to be a pretty week. We're definitely going to have to lighten up on our NUGT position. Speaking of NUGT, weekly view, you could argue that we have a double bottom setup forming here, maybe, or you could be setting up for a steeper lower low and a lower high on the Stokes. So this critical support level here at $25 per share is just that. It's critical support. And we closed at 25.49. We did flirt with the support level at 25.13 on Friday. If we close down below that level, we need to stop out of the additional third and perhaps even sooner. If we put in a new weekly low, we rally back. I just may lighten up on NUGT and look to see if we, in fact, close the week out above $25 per share. If we don't, I don't want to be long of NUGT as heavy as we are right now. And I would be looking to sell very close to the money call contracts on our remaining position. I know Pat was looking at the 28 strike price. That sounds like a good strike to sell covered calls on, 28, 27. I'm going to wait as long as possible, perhaps even till Wednesday, to open up those contracts. Because don't forget, we have a lot of economic data coming out on Wednesday. You have the Fed heads out there. And if they imply, if they even allude to the fact that they're going to be buying longer dated debt, you can bet your bottom dollar NUGT and gold are going to catch a bid in a very, very real way. Now, I'm not predicting that. Frankly, it's more hopeful thinking or wishful thinking on my part. But if we do close down below the $25 per share mark, even on a daily basis, we're going to have to look to stop out of another third of our NUGT position. Better to be safe than sorry. Taking a look at Cure. We're setting up for a continuation move here. We've already broken out on a weekly basis. I think that any pullback can be bought here. Let's go to a daily chart. See how we're setting up for the coming week. And if you don't want the volatility, just go with the HLV. Beautiful price action on Friday. An outside reversal bar closing at the highs of the day on Cure. Good volume. I think we move higher here on CURE. I also want to talk about LABU. It broke out last week and closed above $40 per share. We've been talking about that number for a while now. So LABU looking very attractive on a weekly basis, on a daily basis. Beautiful outside reversal bar on Friday. It looks as though we are heading up higher here on the LABU. Okay, leaving off with the USLV. Hit hard last week. The next support level, if we don't gap up tomorrow, is going to be right down here at around $75 per share. So I would not be a buyer. We are not oversold here. This is not a bargain by any stretch of the imagination. Daily chart. Bearish reversal bar on Friday. And here's that support level here at $75 per share. Allow it to come to you. Allow it to base. I see no reason whatsoever to go buying any more USLV right now. We are on the opposite side of the mountain, the dark side. Here's the bright side, the sunny side. Now we are on the dark side. Let's not add more here to a losing trade. Once we begin to see consolidation, 4-hour chart, then we could discuss adding more. We are a bit oversold here relative to the 3rd standard deviation Bollinger Band and the 2 standard, but not enough for me to want to go dipping my toe in the water. In all probability, we are going to move lower tomorrow morning. But I think that we'll probably get a rally this week on silver. Short-term rally. I don't see any reason to go chasing that rally whatsoever. And that is it for this afternoon, folks. Everybody have a great remainder of your Sunday. I may do a Sunday night Futures Live video. I'm not quite sure. I'm just not really feeling all that up to it. But if there's something on the headlines that's interesting, I may just move forward with it. So more to come. I will send out a notification if I decide to go live tonight. Everybody have, again, a great remainder of your Sunday and weekend. And happy Veterans Day to everyone. Be well.